Imagine trusting someone with your entire life savings, your children's inheritance, your charity's endowment, only to discover it was all a lie. Every statement, every return, every promise, fabricated. On December 11, 2008, Bernie Madoff confessed to his sons that his investment advisory business was, quote, one big lie, and that he had stolen approximately $65 billion from thousands of investors. It remains the largest financial fraud in human history. But here's what makes this story truly chilling. Madoff wasn't some shadowy figure operating from a basement. He was a former chairman of the Nasdaq Stock Exchange. He was a pillar of Wall Street respectability. And for nearly 20 years, he looked his victims in the eye, shook their hands, and systematically destroyed their lives. This is how he did it, how he got away with it for so long, and what his scheme reveals about the dark psychology of trust and greed. Bernard Lawrence Madoff was born on April 29, 1938, in Queens, New York, to Ralph and Sylvia Madoff. His parents had tried and failed at running their own securities business. And some historians believe this early exposure to financial failure planted seeds that would grow into something monstrous. In 1960, the 22-year-old Madoff founded Bernard L. Madoff Investment Securities with $5,000 he had saved from working as a lifeguard and installing sprinkler systems. His wife Ruth's father loaned him another $50,000 to help get started. In those early years, Madoff built a legitimate and genuinely innovative market-making business. He was an early pioneer of electronic trading, and his firm became one of the first to use computer technology to process trades. By the 1980s, Madoff Securities was handling up to 5% of all trading volume on the New York Stock Exchange. He served on the board of the National Association of Securities Dealers and eventually became chairman of the Nasdaq Exchange. Bernie Madoff wasn't just successful. He was respected. He was admired. He was the definition of a Wall Street insider. And that reputation became his greatest weapon. While his legitimate trading business operated from the 18th and 19th floors of the famous Lipstick Building in Manhattan, something very different was happening on the 17th floor. There, behind locked doors that even most employees couldn't access, Madoff ran his investment advisory business. And it was entirely fictitious. The scheme worked with elegant simplicity. Investors would give Madoff their money, believing he was using a sophisticated strategy called split strike conversion, which involved buying stocks while using options contracts to limit risk. Madoff claimed this strategy generated consistent returns of 10 to 12% annually, year after year, regardless of market conditions. In reality, he never invested a single dollar. The money went directly into a Chase Manhattan bank account, which at its peak held over $5 billion. When investors wanted to withdraw funds, Madoff simply paid them with money from other investors. Classic Ponzi scheme mechanics, but executed at a scale never before seen. What made Madoff's scheme uniquely dangerous was his psychological manipulation. He created an aura of exclusivity around his fund. He famously turned people away, making potential investors beg for the privilege of giving him their money. He recruited heavily within tight-knit communities, particularly Jewish philanthropic circles and country clubs in New York and Palm Beach. Investors felt they were part of an exclusive club. They didn't just trust Madoff with their money. They trusted him with their identities, their social standing. Questioning him would mean questioning the judgment of their friends, their rabbis, their community leaders. One investor later recalled, quote, "It was like being invited into a secret society. You felt lucky to be there. But not everyone was fooled." In 1999, a Boston-based financial analyst named Harry Markopolos was asked by his employer to reverse engineer Madoff's strategy. After just 4 hours of analysis, Markopolos concluded it was mathematically impossible. The returns were too consistent. The strategy couldn't generate that kind of performance. In May 2000, Markopolos submitted a detailed complaint to the Securities and Exchange Commission titled, quote, "The world's largest hedge fund is a fraud." He was ignored. He submitted another complaint in 2001. Ignored again. In 2005, he sent a 17-page memo to the SEC with the subject line, quote, "The world's largest hedge fund is a fraud," and presented 29 red flags proving Madoff was running a Ponzi scheme. The SEC conducted a superficial investigation and closed the case. Over nearly a decade, Markopolos approached the SEC 5 separate times. He warned journalists. He contacted the Wall Street Journal. Nothing happened. Years later, Markopolos testified before Congress, saying, quote, "I gift-wrapped and delivered the largest Ponzi scheme in history to them. And somehow they couldn't be bothered to conduct a thorough and proper investigation." The SEC's Inspector General later found that the agency had received 6 substantive complaints about Madoff between 1992 and 2008 and bungled every single investigation. The reasons were damning: inexperienced staff, lack of financial expertise, and an unwillingness to challenge a powerful Wall Street figure. What finally brought Madoff down wasn't the regulators. It was the 2008 financial crisis. As markets collapsed following the Lehman Brothers bankruptcy, panicked investors rushed to withdraw their funds. In November 2008 alone, clients requested $7 billion in redemptions. Madoff had only $200 to $300 million in the bank. There was simply no more money coming in to pay investors wanting out. On December 10, 2008, Madoff told his sons Mark and Andrew that he wanted to pay out bonuses early that year, totaling $170 million. When his sons questioned where the money would come from, Madoff broke down. He asked them to come to his apartment the next day. There, he confessed everything. The investment advisory business was a fraud. It had been for years. He estimated losses at approximately $50 billion. His sons immediately contacted a lawyer, who contacted federal authorities. On December 11, 2008, FBI agents arrived at Madoff's luxury Manhattan penthouse. When they asked if there was an innocent explanation, Madoff replied, quote, "There is no innocent explanation." He was arrested on the spot. The devastation was almost incomprehensible. Prosecutors identified nearly $37 billion in actual investor losses, with paper losses reaching $65 billion when fabricated gains were included. Thousands of individuals lost everything. The Elie Wiesel Foundation for Humanity, named after the Nobel Peace Prize-winning Holocaust survivor, lost its entire $15 million endowment. Director Steven Spielberg's Wunderkinder Foundation lost millions. Celebrities, banks, hedge funds, universities, and ordinary retirees were all victims. Some couldn't survive the loss. French investor René Thierry Magin de la Villehuche, who had invested his clients and his own money with Madoff, took his own life in his Manhattan office 2 weeks after the arrest. He left no note. Mark Madoff, Bernie's older son, hanged himself on December 11, 2010. Exactly 2 years after his father's arrest, his younger brother Andrew died of cancer in 2014, having reportedly blamed stress from the scandal for his illness. On March 12, 2009, Madoff pleaded guilty to 11 federal felonies and admitted to running the largest Ponzi scheme in history. On June 29, 2009, 71-year-old Bernie Madoff was sentenced to 150 years in federal prison, the maximum allowed. Judge Denny Chin called his crimes, quote, "extraordinarily evil." Madoff was also ordered to forfeit $170 billion. He died in federal prison on April 14, 2021, at the age of 82, having served just over 12 years of his sentence. The Bernie Madoff scandal exposed catastrophic failures in financial regulation and forced painful lessons onto investors worldwide. The SEC underwent significant reforms, though critics argue they didn't go far enough. A court-appointed trustee, Irving Picard, has spent over a decade recovering funds for victims, clawing back more than $14 billion from those who unknowingly profited from the scheme. But perhaps the most important lesson is the oldest one in finance. If something sounds too good to be true, it probably is. Madoff's consistent returns through bull markets and crashes, his air of exclusivity, his resistance to scrutiny, these were all warning signs that thousands of intelligent people chose to ignore because they wanted to believe. They trusted reputation over verification. They confused social proof with due diligence. And they paid an unimaginable price. In the end, Bernie Madoff didn't steal $65 billion because he was a genius. He stole it because people wanted to believe in him. And nobody with the power to stop him bothered to look closely enough at the truth. If this story taught you something about the dangers of blind trust in finance, please subscribe for more financial crime documentaries. Hit the notification bell so you don't miss our next investigation into the dark side of money.